Good evening, ladies and gentlemen. Well, according to the risk dial, nothing much happened last week, although a few Chinese did catch a cold, hence this week's title. 46 basically is very small change from the 50s and 48s that we've had over the past several days. We are still in risk on, there's absolutely nothing new there, but we do have this warning here. We are turning a little bit, but it's still far too early. Don't forget, this is a trend following system, and therefore it is unlikely to change until the trend has definitely changed. The monthly will definitely not change, even at the end of the month, whatever happens. The score would have to probably go negative for that to happen. So we are in risk on for the foreseeable future on the model, which basically means that none of the spreads have got worse enough for the market to be in a big deal. If we look at what deviations are saying, basically it's just unsustainable, going into the red, and all we're doing is coming back slightly. I won't bore you with going through all of them, but this line here is going to be for me absolutely crucial and very, very strong, and that, in a couple of days is going to be somewhere around the 3180, possibly 3200 area, and we'll see why that one is going to be extremely important. Below there, and something really bad is going on. I have no idea what, but I am not going to hang around below there, and I will change my mind. But if you have a look at all the other sectors, energy is hugely oversold. IYZ, the telecoms, is still overbought and has room to come down. The one that's unlikely to come down for the time being is XLU, because everybody wants bonds. You will see that XLK definitely has room to come down and test these levels here. But I will go through all these in further detail. The Blue Angels have definitely started turning upwards, and really the times 18 Blue Angel is here at 3200 to provide support for the market. That's all I can say. I can see no reason for multiple contraction while bonds are so stable to bid to lower in yield, unless people start talking about recession. Now, is a recession possible with a world pandemic? Absolutely it is, but there is a lot of time and a lot of things need to happen before we start getting bearish on this market. I am still in buy dip mode. I see no reason to be anything else. The facts at the moment, and I'm talking about the facts, are unknowable. We're not epidemiologists. We just don't know. We can't tell what the Chinese government is doing, how effective it is to stop the spread of this epidemic. Far too early to tell. We must deal in facts, and the facts say that times 18 is going to be support, and that's 3200. What are bonds saying? Bonds lie least. I would have thought the bonds are saying that the sheer weight of money is going to drive this lower in the 2-year down towards these kind of levels, 143, or even this 137, 138 level. I really don't see the Fed moving just because there might be some chance of an epidemic in China. That has to come through in the numbers. They will be probably very quick to react once there is evidence, but there is none at the moment. So really the idea of buying 2 years below 145 in terms of yield is silly. The risk reward there is very bad. You're looking to make 4 or 5 basis points, and you could lose triple that. So I think the risk reward in the 2-year is pretty damn bad. This is the chart of the 2s, 10s, and as I said last week, I was very slightly short. I still think this level trades 13 to 14 basis points. and that is going to be your weight of money in the next few days. People abandoning risk for the safety of bonds and zero yield, zero real yield. Good luck to them. I think at this level, at 13 to 14 basis points, the risk reward is definitely back up to the upside in either case, because if the SARS virus, this whatever it's called, this virus proves to be absolutely nothing, then I think we will go slowly back up towards the 30 level. And if it does prove to be something, we will go much higher, because the Fed is going to be very quick to lower rates. The fives, just emulating this picture here, but you can see there were a couple of real dips, and we could have one of those again. Basically, if 145, 146 gives way, we're going back towards the 133. But there again, at that kind of level, or even better at 117, we are really, really on fumes. And I don't think the 2's 5 stays inverted for very long. And I certainly don't think that the 2's 10s goes negative or even goes below 13. So really, the risk reward is getting worse and worse and worse in these in these bonds. But the weight of money will carry it. I have very little doubt of that. If we have a look at where the 10s are, it's very likely that we can trade back down here towards the 145 to 150 area. Every time we've done this kind of pattern, we've done one move back down towards the 140 level. So it's likely that we will test at the very least this kind of area, the 155. Beyond there, really the risk reward is very bad, very bad. The picture is far more muted in Europe. This is the bubble, the 5-year. We are unlikely really to start breaking this 61 level, which I said is the floor. And if we do, then really I wouldn't fight it until 70. Now, this I will allow to break through sheer weight of money, but minus 70 is going to be a wonderful risk reward for the other way. If we have a look at the 10-year, this is exactly, basically, sort of a couple of ticks through, but my levels are pretty damn good here. I think the first level that it'll stop is minus 39, and if it goes through minus 39, which I really don't expect, then we could start going quite a little bit lower, but that would be panic stations. That really would be panic stations. Minus 39 to minus 41 is all I can see here in the Bund. So I really don't think that it's worth pushing your luck further than that. Well, the yield differential between the 10 years in the States and the 10 years in Germany is definitely on a downward path. It's been remarkably stable for the past 5 days, but I think this is some sort of a bear flag, and I do think that it goes down towards 190, simply because I can't see the Bund being that much, being able to keep up with a 10-year note in a panic. That is normal, and that should really presage a lower dollar, but I don't think that's going to happen this time, simply because when people panic, they buy dollars. So it is counterintuitive, but even a move down towards 190 in this spread, I don't think is going to be enough to turn DXY until the panic subsides. Well, nothing's changed in 2020. Basically, DXY is here to make everyone's life as hard as possible. I don't see the trend. I really don't. Basically, it's in a huge range between 96.47 and let's call it 98.33 or possibly 99.79. So if 97.87 doesn't hold. We're looking for 98.33. I think these spikes to 98.33 should be an opportunity to get some options to get back down towards the 200-day moving average at the very least. But it's a time of panic, and in times of panic, people do stupid things. So options is the way to go at 98.33. You know, a few put spreads looking for 97.50 again, and that's about it. The one I'm becoming a bit tactically bearish of is actually cable. I think these repeated failures here around the 131.5, 132 area indicate that it's unhappy at these levels. It'd much rather go down towards the 200-day moving average in an ABC kind of pattern back down to this 127.50, 128 kind of area. Could be a, you know, buy the rumor, sell the fact, January 31st, Brexit, thank you very much, yours. I'm uncomfortable really looking for a much higher cable. I don't see what's going to cause it at the moment, and really it would have to be profound dollar weakness, because I don't see sterling strength doing it. So I think 128 is more likely than 134. Tough to argue that gold is not in an uptrend. It is, and it's crawling up the top of these of the Bollinger Bands. If we try to enlarge it, it's very, very difficult to get very long up here. Dips will be bought. This is a weekly chart, and you can see how well that 1457 level works. Damn it. I can't see it really above 1600 for any length of time, unless there is another very piece of bad news coming out of China. And to that effect, I will show you what I'm looking at to give me the levels for getting out of asset classes, i.e. getting out of gold and going into equities, and getting out of bonds and going into equities as well. Well, this is the chart of SPY over GLD. You can see how it's been remarkably stable for the past, I don't know, 2 years. This is the kind of level that I'm looking at, 210, where the 200 period moving average is. That is going to be very, very good support. And you can see that we have a series of highs here at, and you can see how important a level this 210 area is. So if we see a move down towards 210 in SPY GLD, that'll be my cue to sell gold and buy equities, because the risk reward there is very good. Now, how far away is that? That's about 4 or 5%. You know, it could be gold up 2.5%, and S&P's down 2.5%. Perfectly possible, gives us that level, and we should bounce off it. But very good risk reward in any case, because if it starts closing through it, and certainly through this you know, this kind of level around 197, then you know that we are in full panic mode, and who knows what's going to happen. The other very important indicator, spread indicator, that I'll be watching very closely is SPY over TLT. You can see that again, just like in gold, we've been remarkably stable for the past 2 years. We haven't really done all that much. We're not very different from the levels that we were at the beginning of 2018, are we? So basically, you would have done just as well holding TLT as SPY for the last 2 years. And that, I think, at some stage has to change, and has to change in a big way. I think it's going to happen through an upward move. But here you can see, if I try to enlarge this chart, how important this around 220 level is. We have the 200-day moving average, we have the 50, and we have this channel that keeps on catching the trend. So anywhere around this level, that's another, what is it, 5% lower, and 5%, you know, it could be 2% on TLT up and 3% on S&P down, and that gives us what, around the 3200 level, right? So everything is coming together. That is going to be a very, very important level. There I basically do as much as I can long S&P options and short short TLT options for it to go down. I think that this is basically as far as the Fed will allow things to go. On to equities by watching the VIX, because that's going to give us the best clues. Now, this is a weekly chart and this is a daily chart. If you look at the daily, really we didn't do very much. We completely failed above the 200-day moving average. We closed back within the Bollinger Band, which is going out. So my best guess is that slowly we tap our head against 16 and then abruptly break it, go up to 20 and then collapse again. That is my best guess. But any close above this 1620, 1630 area, I think it'll definitely expand up towards 20. You can see with what regularity it's done it before. All it takes is a couple of headlines and it can go 3-4% just like that, people hedging. So that is going to be our indicator. That's going to be our best guess as to what the situation is. And yes, why not? This definitely has far more potential to go up than I think the market has to go down once it's down another % or so. Right, on to the really volatile one, and we will examine it now basically from time tone to time frame. The lowest one I like to look at is the 195 minute, because it divides the day into two. And yes, we are likely, probably from what I can see on IG, to open below 3280, but who knows. And then this becomes huge support between 3258 and 3265. That is where the first wave of buying will come in, and really if we can enlarge this, we will see that really nothing above while the market remains below 3209, 3210, I'm definitely not tempted to buy it yet, because the upside to me is around here, 3203, 3205. That to me is the upside. People will want to get out at that level. Only if, who knows, but the news could be all solved, there are no more problems, and off to the races we go. But we'll only know that when we start breaking this 3210 area. Before that, I really don't want to know about the upside. But really, this is going to be the first support. We have a gap there. First support, first wave of buying is going to be here, and that is all we can say from this time frame. Now, if things should get bad, we should look at other time frames, i.e. the dailies. The daily time frame is the first one that makes sense to look at. We still haven't done anything bad here, it's really not that bad. These moving averages also come in, as you can see, 3261. We haven't been below the red moving average since very early December, and then we recaptured it the same day just about. So I really wouldn't want to be that short below 3260 without a headline, a reason. But if that reason comes, down we go to the Bollinger Bands and here, and the 50% retracement, which comes in at 3204. That is almost a given, because there's air between these levels, and we will come pretty damn fast down towards the 3200 area. Now that is going to be 4% off the highs. That is going to be a decent level to start thinking about selectively buying some names which could easily start outperforming in the next in the next wave up. Now that is as far as I'm prepared to go now. 3205. But if things get really bad, and this is what worries me, I mean, no, it doesn't worry me because I don't know what the headlines are going to be, but if the headlines start getting really apocalyptic, this is the weekly chart, okay, and the weeklies then have anything down till 3116, that kind of level, 3120, okay, might be a couple of weeks later, 3140. So that's another couple of percentage points from the 3200 level that I think is going to be very, very hard to break initially. That is all I can say, apart from the fact that here we are with our monthly friend, and our monthly friend, I keep on telling you, it always revisits. Every time I look at this, it revisits the level that it came back, it went through the Bollinger Band at, and really we are still above the Bollinger Band, which comes in at 3264 for the end of this month. So we have quite a bit of room to go down and really have changed absolutely nothing. 3130, 3120 means nothing in this market. Still in a very strong uptrend. We will have to monitor it day by day, hour by hour. But we have our game plan. The first buying level we cover at 3260, and then we play it by ear. We look for tactical levels to short it, probably by being long of volatility rather than anything else, because the risk reward there is better. That is all you can do in this kind of a market. Pick a good technical level, get long at it, and then hope and see what the market gives you. I always try to look for clues from related markets, and this is the RUT, the Russell. 1645 to me is going to be a very important level. Probably the first level to attempt to bounce from 1645. But if we start breaking through 1645 and filling this gap, then the market is weak. This was, I mean, let's face it, all we did last week, this is a weekly chart, is an inside week, okay? That's all we did. We didn't do anything more exciting than that. So if we now start breaking down below 1645, I think really 1602 or 1605 or something like that is almost given and on the cards. Which will really start to drag on the other indices, because that will be a sign that people are beginning to seriously dump equities. I don't think that's going to happen, but that is going to be my clue. Closes below 1645, and I start getting worried that the S&P definitely is going to trade the 3200 handle. The other market that's definitely going to be volatile, EEM, but I'm not worried about it longer term, although I might be worried about it shorter term. You can see how the risk reward up here was not good, was it? Just as I said, we could easily come back down into the 42s. Easy peasy on a monthly basis. If we have a look at a weekly basis, no problem at all. Down here, we could easily come down to 4150, 4250, and if we go on a daily basis, really the 0.76 retracement is around 43, and the 200-day moving average slowly moving towards 42.5. Not unlikely, but I think that those are going to be excellent levels to buy. Just brilliant for the rest of the year, because let's face it, at some stage this thing will be beaten. Onto the biases, 151, 171, but sheer panic and weight of money in the twos are likely to carry them to 137. But if we do see that level, I think it's a great level for a counter trade. I don't think the Fed is going to do anything until there is ample proof of something, that something really bad is going to hit the economy as a result of this virus. It could be nothing, right? So I'm sure the Fed will err on the side of caution until it's proven, and only then act. Fives, 135 is possible, as I showed you in the video. I doubt it. Again, I think twos and fives at those levels, 137, 135, when they're equal, probably a very good short. The yield curve I showed you around the 14 basis point area, very good risk reward there, because I think there it's almost a free play. I think whatever happens from that level, I'm very comfortable having quite a position in twos, tens. Bobble and Bund, those levels have not broken yet. I've given you the alternate levels, but between 0.61 and 0.7, I think it's well worth fighting the bobble again. Right, well, SPX is the one that's going to be exciting for everyone. First support after 32.80 that you saw on Friday, how well it held, is going to be 60 to 55 area, and I explain to you why. But the real strong support could be around 32.04. So I think this could be an A, followed by a bounce from 60.55 back up to 32.90, 95, fill the gap, C down to 32.04. That would be lovely, because then we know to come in and buy it. VX, if things go pear-shaped, is going to be far more explosive. I think VX is going to be well over 20 when the S&P is at 32.04. So the risk reward, if you want to go for a short in the S&Ps, buy VIX instead. European equities, I don't have any clue there, any particular clues, but I'm really not going to step in before 12,725 in the DAX. I see no reason to step in if the other related markets are going to be thrashed by the risk-off move. But the ones I really am going to watch are those SPY, TLT and SPY, GLD charts. Those are going to give me very good clues about what is going on. 98.33 here in the dollar is going to be absolute key. I think that in times of panic, the dollar tends to benefit. So from 98.33 we will see, but probably worthwhile doing a 1x2 on the downside, that kind of thing. And EEM is the one that I think, if everything gets trashed like here, it'll get trashed to this kind of level. But I think this is going to be the most amazing buy, and we should do some sizable option plays at those levels. Thank you very much indeed, and tweet you on Monday.